one of my children can't manage money.
Okay.
You may have a trust in place where it says, let this person have X number of dollars per year or a certain percentage of those assets each year for a certain number of years. Or you can have it go to them a lump sum here today, 3 years from now they get this, 5 years from now they get that. But it's used where you can basically tailor make it any way you want those assets to go to your beneficiaries for that purpose. And then over time, what happens, people adjust the trust because life changes.
Okay.
And I've had a case recently where one parent cut one of the children out because they felt like they weren't going down the right road, and they decided to just cut them out and not leave them anything.
Okay.
And this is a person that's got probably, $4 to $5 million of assets. So they just cut one out because they just weren't satisfied with that. So the trust would be used where it's a private document where you can put things together and change those over time so that it goes to the person you want it to go to.
Okay. And one more follow-up question about that. So where should people go to get these things done?
Okay. To do wills and trusts, you have to go to an attorney. And every state is different, so you have to get an attorney in the state that you live in. And you want to get an attorney who practices family law.
Okay.
That's the key to it, because if they practice family law at least 50% of the time, then they're pretty comfortable and know how to put these things together to help you meet what you're trying to do financially related to those assets.
All right. Since we're speaking about family, the main reason most people get divorced is finances. So what do you think about prenups and postnups, and how should people go about them?
Prenups, I would, if that's what you feel you need, I would recommend doing that. What you may want to do in that process is maybe also talk to a financial person or maybe even an attorney and putting those things together, because there may be a number of things that an attorney can talk to you about or a financial person can talk to you about, of things that you should consider that's going to be in your best interest related to putting together a prenup agreement for that purpose. So if that's something you feel that's necessary, then I would say, do that, but also do your research to make sure that you've got somebody that's helping you do that.
Okay.
That's used to putting those together, because they've experienced a lot of things, and that's things that I'm pretty sure an attorney or a financial person can tell you about that you may not even think about related to your finances.
All right. So now let's go talking to people trying to plan out for college. So what would you tell people to plan out for their kids' college, or even some kids are trying to take initiative early and also figure out some ways to get scholarships and grants and avoid getting a whole lot of debt for college?
Okay. One of the things I suggest, even when I talk to parents, is that planning for your children, saving money for your children's education is not necessarily a priority.
Okay.
It's something you choose to do. My generation, parents didn't have money to save for college. So we were on our own to do that. Fortunately, when we came through in the 60s and 70s and probably even early 80s, there were enough grants and things available that you could access money and not loans, and then be able to work while you're in college at the same time to pay your way for that purpose. A lot of times now with parents, they, part of the planning process is, I want to save money for college. It may not necessarily be 100%, but they save some.
Okay.
And then what can happen with the student that's getting ready to go to college, one of the things they can do to kind of avoid loans would be to work while they're in college if they can.
Okay.
Because I worked a job when my first 3 years of college. I think I was working about 30 hours a week. I had a routine down where I take my classes in the morning, study, go to work in the afternoon, study at night.
Okay.
And kept my weekends free. And then I came out of college, I had no debts, and back then I had, I think, in today's dollars, the equivalent of probably about $15,000 when I left college.
Okay.
Because I was working and saving money while I was in college at the same time. So there's ways to do it, but I also say that if that's your last resort for loans and your college material, I would say do that. But the key to the loans is to try to pay those off as soon as you can once you get out of college, so you don't have that debt lingering. I met with a client recently in Florida, and they're 33 years old, and they still have $400,000 worth of college debt.
Okay.
And they've been deferring it because of the pandemic and so forth, and they haven't made any payments in 3 years, whereas they could have been paying a lot of that off with no interest.
Yeah.
At the same time, but they chose not to. So it's, for a number of people, it's having a negative effect because they still have those student loans out there. What I would generally recommend that they do as soon as they can to get those paid off. And that may mean taking a second job to do it.
Okay.
At the same time, and all these things about income and expensing and budgeting and so forth. If you're spending more money than you're making, and you can't change that, then you probably need to get a second job.
Okay.
That's one thing a lot of people don't want to do, but it's all depending on how important finances are to you.
Okay. The next segment I want to go into was about insurance. So how important is getting life insurance early, and what are some of the things you should look for when you get life insurance?
One of the key things with life insurance is you would have life insurance in place if someone else is depending on your income. If you've got a spouse, if you've got children, and they're depending on your income, then you want to have life insurance in place for that purpose. And the way you look at that, I do planning, my concept or philosophy related to insurance, or the type of insurance you use, would be to use term insurance.
Okay.
Because if you're doing financial planning, even at a young age, and you're accumulating assets, you say, okay, I'm in my 20s or whatever the case may be, I've got 30, 40 years that I'm going to accumulate assets. You can get your term policy that covers that period of time to allow you to grow your assets so that you can get to retirement. And if you've done that, then you don't need the life insurance at that point in time, because I've got enough assets to live off of. My children are grown, they're gone, and I was covered during the period of time that if something happened to me, there may be $1 million or $2 million in place where my spouse doesn't have to worry about, what's going to happen the next week after their, the first spouse is deceased, or my children going to be able to go to college because you got the life insurance in place. And typically, I use the term insurance because it's cheaper, and also because it allows you to use your other money to do other investments at the same time. And that's another reason why I ended up getting into this business, because when I was doing taxes the first year, I had an insurance person came to me, and she wanted to sell me life insurance. So back then, we didn't have personal computers, so they had to come back a second time a week later to get their tax return. So by the time she came back a week later, I knew more about life insurance than she did.
Yeah.
And she was trying to tell me, I'm 28 years old with a spouse and a house with debt, and she was trying to sell me a $50,000 cash value policy.
Mm-hmm.
And I went back and did my research. I said, no, I don't need that. I need $500,000
Yeah.
of term insurance that was cheaper than that $50,000 cash value policy was. Because if something happened to me, my wife couldn't do a whole lot with $50,000, but she did much more with a $500,000.
Okay.
And I had a 30-year term, and basically that's what, that's the way I look at life insurance. And for most of the clients that I work with, we've done that, and they've accumulated assets over time. Now, if you're not accumulating assets, it may not matter what kind of insurance policy you have, because that means you're not gonna have a whole lot of assets, period, for that point in time.
Okay. And the next one, I want to go into a little bit about health insurance.
Okay.
So, what are some different health insurance plans people can get?
Yeah, probably, it's not necessarily different. It's only a few carriers that are out there. Probably your biggest carriers for life insurance is United Benefit and Blue Cross Blue Shield.
Yes.
And typically you want a comprehensive healthcare plan, so that if anything happens to you, then you basically have a deductible, which depending on your situation, if you're single, I don't know what the deductible is, but if a married couple, it's typically $6,000 that you which basically says the first $6,000 in a year, I pay that, and once I pay that, then the insurance company pays anything above that for the rest of the year. So if you have a major catastrophic illness or something, then you don't have to worry about that, because you pay the first $6,000 as a family policy, and then the rest of that's going to be covered. But that's definitely critical to have, because this day and time, it's not that a lot of people are dying, but a lot of times people are getting sick.
Yes.
And they need policies at that point.
Okay.
And healthcare is important to have.
Okay. Next question I got about is tax planning. Can you talk about a little bit about what goes into tax planning, and also on the back end, could you talk about what is a tax credit and a tax deduction?
Okay. Talking about tax planning is another part of financial planning, where you're basically looking at what you're paying in taxes and how can you change what you're doing to take advantage of certain tax laws.
Okay.
Related to that. For most people, the big ones that they utilize is basically the 401k plan, where you put money in on a pre-tax basis, which basically means if I'm in a 20% tax bracket, for every $100 I put into my 401k plan on a pre-tax basis, that saves me $20 in taxes. Which basically means I come out of my pocket $80, and then $20 in tax savings is part of the $100 that goes into my retirement plan.
Okay.
And if the company's matching, then that's more money going into that program as well. So that's a big one. The home mortgage interest is another big one that a lot of people utilized over the years. And the fact that most of us cannot afford to buy a house for cash, so that's why we have a mortgage.
Okay.
So the law made it available that you can use mortgage interest, taxes on your personal residence as a tax deduction on your tax return. And you asked the question about, what's the difference between a tax credit and a tax deduction. A tax credit is a dollar for dollar reduction of your taxes.
Okay.
If you have a tax credit, because like say, take one for example, home energy tax credit. They may give you a $500 tax credit if you put in certain kind of windows or solar panels on your house. I think it's up to $7,000 tax credit, which basically means that $7,000 tax credit goes against your taxes reduction. Whereas a deduction is basically reducing your taxable income, and then whatever your taxable income is after that is what you pay taxes on. So that's the big difference. One is a deduction, and one is a dollar for dollar tax credit against your against your taxes.
Okay. All right. Next one is just like a finance question in general, because as I was going around and asking a lot of people that's just coming to college, a lot of them didn't understand what's the difference between like a debit card and a credit cards. So could you go over that for us?
Credit card is basically where you basically buy assets or buy items. You put them on a credit card, and one, you can either pay it off at the end of the month when you get your credit bill, your statement, or you can carry that over time where you pay interest plus the principal on whatever you purchase for that purpose. A debit card is basically a card that you use where you basically you use it like you do a checking account. If you use it, the money's coming directly out of your account as soon as you do that. Whereas with a credit card, you basically putting money where you're using money where you say, I'm going to pay it off over time. But you also have to keep in mind when you use credit cards, can I afford to pay that card off at the end of the month?
Okay.
Because for a lot of people, they use credit cards because they're trying to have a lifestyle that's more than their income. And they say, well, I'll just pay this off over time and eventually we pay it off. But what happens is, for a lot of people, there's an emergency or a situation where they keep using the card over and over and over again. I've got a person that makes a significant amount of income, but their lifestyle is such that they're always spending more than they're making. And this is probably about the third time this person has had over $100,000 worth of credit card debt.
Okay.
And he's been out of control. He's probably in his 40s now. They were out of control when they were in college, and they've been through this several times over their lifetime. But they keep spending money because of things they want to do, and when they look up, they've spent $100,000 more than they were able to pay off. At the end of each month. So what you want to do is you want to be able to control the credit cards and not let the credit cards control you, because you can get out of hand pretty fast in trying to have a lifestyle that's greater than what your income is.
Okay. So the next segment I'm going to go to a very special segment to me. So now I'm going to think about somebody that's just graduated college, they're about 22, 23. They get a corporate job, they're making about $80,000. They're maxing their 401k out, getting their 6% match. They're getting their equity awards. They're doing everything they're supposed to be doing. They're not living above their means. So what is some advice that you would give to them?
Well, I would probably in the 20s to look at exactly probably the big advice I would give that person, it sounds like they're doing everything right, is the key thing that you want to do, because since we're talking about finances, we're talking about financial planning, in order to meet your financial goals, you've got to have money.
Okay.
In order to have money, you got to have a job.
Okay.
In order to keep that job, you got to keep your skills current and marketable, so that you can always be either employable or be able to sell your services to somebody. One of the things I say one of the last things I have written in my financial plan when I do a plan for a person is that you always got to look at where's your industry going in the future.
Okay.
Because you want to be at least with it or ahead of the ball game, so that you can know you can always be employed somewhere because you're good at what you're doing.
Okay.
And that came from meeting with a client one time early on, where the spouse raised the question, the plan sounds good, whatever, what would keep us from meeting our financial goals? And before I answered the question, I quickly went to my mind, well, we're talking about money. And in order to have money, you gotta have a job. And in order to have a job, you gotta have skills.
Yes.
And then the other part of that is the world is constantly changing, so you gotta always look and see where your industry is going over time. Because I've had some people, and I've got a couple of guys now that they're in their 40s, and they were doing certain kind of IT work for a company, and they got skills that were very remarkable. They were able to go out on their own, and they were making a couple $100,000 doing that through their company. So they went out on their own, and these guys are making $600,000 to $800,000 to $1 million a year, just working at their home and sitting at the computer because of the skills they have, skill set. So if you're good at what you're doing, somebody's going to always want your skills.
Okay.
And they're willing to pay for it. So I would recommend, if you're doing all the right things, then you want to stay on top of whatever industry you're in to make sure you're current and marketable in that industry.
Okay. So how much did you save? Let's say you got your emergency fund there, you got your regular savings there. How much of your money should you be saving?
At different points in time, you can save different amounts of money. And I use that example that there's no two people that are equal. Everybody does things differently because you have a different idea of where you want to be financially. And that's, to me, it's not the important idea. It's just, are you able to save money to meet your particular goals? And you start off with a 401k, and what happens over time is that your income needs will change, because you can start off in your 20s making $80,000, but it's quite likely during your career you could be making $400, $500, $600 million at some point in time, depending on what you're doing. So your goals will change, but your lifestyle may not change, because all of us have what I call a basic lifestyle that we want
Okay,
to do, certain things that we want to do. So once you get to a point, your expenses should level off, but over life, your income can still continue to increase, and that just means you've got more money to save
okay,
and invest for that purpose. So I would kind of look at it based upon, you know, are you comfortable in what you're doing? Do you want to have do you have the goal of, I want to make more money because there's more things I want to do? So for each person is different related to that. So I wouldn't say there's a set number or set percentage of your salary, but typically I would say, you know, sit down and make sure you're doing a plan where you are saving, first of all, the amount of money you need to save to meet those goals.
okay.
But again, those goals will change over time, and it's just a matter of making adjustments over time to do that. Because I've got people that I sit down with and have been working with for 20 years and some years